Good morning, everyone, and welcome to the AFA webinar, our update on professional standards and policy and professionalism. I'm Phil Kewen, and so glad to see so many of you here this morning. So welcome. For many of you who attended the recent Connect Roadshow, this is a presentation that we did do to all of attendees, but we have updated based on the current information we have to hand. And of course, it is extremely topical. We are talking about the future of our profession and the future of advice. And so obviously it's important to all of us. Now, the future of advice is forever changing. We know how important it is and how important it is to you and your businesses. But we know the value of advice to customers has never been greater. Yet we still have less than 20% of Australians still trying to seek advice, and we need to try and change that. But we know from our industry's perspective, we've been through over 10 years of regulatory change, and it doesn't seem to stop. We've only just seen the introduction of the life insurance framework, and of course, now professional standards legislation. And we'll talk a lot about that today, and I'll be joined by Phil Anderson shortly. Now, it's a lot of anticipation, but we finally have had an announcement of a Royal Commission. Now, we know that the Royal Commission is not specifically targeting individual advisors and advice, but it's impossible that we'll actually escape being involved in the Royal Commission. So there'll be more focus and more scrutiny. And the other thing that we'll notice is that a lot of the institutions will have to spend a lot of time, and so it is quite possible there'll be quite a bit of distraction in our profession over the next 12 months. So we know the cost to serve is becoming more and more expensive. So we're looking for more efficiencies, we're looking for new opportunities, and we're looking to discover the future of advice together. And that's why we've themed the AFA theme for 2018 as Discover. Discover the best you can be, discover the future of your business, and as I said, discover the future of advice together. So I just wanted to touch on a few things just in terms of, in that context, what is the AFA strategic focus? Now, the first thing is that I know everyone I speak to, and I'm sure all of you are all committed to professionalism. We know that's the one way to get the reputation that we deserve so more and more people will seek advice. But really importantly, through this transition, it's so vital that we retain the wealth of experience. So many of you have such rich experience, and it's our priority to make sure that we retain that experience in the marketplace. And it's going to be around education guidance, tools, and coaching. For many of us, most of us indeed, there will be some type of new education or assessment to be undertaken. So we're in this together. And by retaining this experience, we also need to grow the future of advice. We need to foster mentoring, so those experienced advisors can match up with new advisors coming through and increase the numbers of advisors, and of course create a career pathway for the next generation of advisors. It's really important that we collaborate, advocate and influence, and this is why it's really important we spend a lot of time working with different regulatory bodies, with ASIC, with government and even other associations where it is in the best interests of our members to ultimately deliver great advice to the Australian public. So the education standards, as Phil will talk about, as we know, are evolving. And so what we're looking at now in terms of courses and design of courses may change based on the FACEA protocols. But what we need to continue to do is advocate and influence on policy, legislation and regulation. As Phil will outline, some of those can't be changed, and some of those we do need to educate and influence on. With this backdrop, the important thing from an AFA perspective is that we promote the value of advice. It has never been more important, and continuously the role of AFA in the broader community. So on the value of advice, some great research done last year by Sun Super just really highlights this. And in our upcoming meetings, in fact, we've already had some meetings with various ministers, and we'll continue to have meetings with the minister and MPs. If you look at the value of advice, this survey took people who have never been advised and people who are currently advised and compared the difference between the two. And you can see that 80% of those advised have more confidence in making financial decisions. 50% felt they had strong financial literacy, where they were advised versus 27% for those who are not advised. And if you look at controlling your financial future, 79% of those people currently advised believe that advice has given them more control over their financial future, and 69% of those advised have a formal retirement savings plan versus 18% who are not advised. This is extremely powerful, and this is something we're going to continue to promote, the fact that the great outcomes from advice, with all this scrutiny, we can't underestimate what it does to our clients, their families, their businesses, and obviously the broader community. Just touching on some of the ways we're promoting this. If you haven't been to the YBI Content Pump recently, please have a look at it. We get over an average of 6,000 views per month on some of the refreshed content that we have there. Our new YBI e-magazine gets over 5,000 views per month, and our YBI experts, your peers, provide 30 of them have provided different articles. So you can use if you want, you can repurpose for your own uses. You may not want to use it, but our YBI experts are more than happy for you to use that information. And of course, over the last 6 to 8 months, we've engaged through Talking Lifestyle Radio, when a number of our experts have engaged and have spoken to over 2.2 listeners across the country on areas specific to financial advice. So they're just some of the key areas where we're really going to continue to promote the value of advice in this backdrop of changing legislation. Now, as I said, obviously professional standards, education, policy is extremely important. We know it's something very important to you, as it does determine the future of our business. So I'd now like to hand over to our General Manager of Policy and Professionalism, Phil Anderson, to give you his update. Phil?
Good morning, everyone. It's fantastic to have you with us this morning. There's over 300 people on this webinar to this point, and we look forward to presenting an update to you of relevance. So this morning I'm going to cover a range of issues, including FACEA and education standards, which is obviously the hot issue right now. As Phil said, we're also going to look at the Royal Commission. We're going to have a look at the introduction of the new complaints body, life insurance framework, and there are some other key policy developments that I want to take you through. If we start with FACEA and education standards, there is no question that this has been a particularly hot issue. We've seen this run very heated discussions through a number of trade media and blog sites. So it is something that a lot of people have engaged in, and it has caused a lot of concern, confusion and anxiety. What I want to do, though, at the outset is just set some context for this. It's really important to, I guess, appreciate that whilst there are some people who are calling for this all to be stopped, it's important to understand that it is already legislation and it has been set up through a period of demand for change. And I'll take you through that now. It all really started in some ways with a Ripoll inquiry in 2009 that made specific references to the level of education standards for financial advice, and there was a number of calls at that time for it to be increased. The second step was in March of 2011 when ASIC released consultation paper 153 that proposed that advisors should sit a registration exam. At that time, they also suggested that advisors should repeat that once every 3 years. The other key part of 153 was the proposal that there would be an introduction of supervision for new advisors. If we move forward to June 2013, ASIC released consultation paper 212 that referred to the increase of education standards, and they proposed that it would be phased in with an increase from the 1st of January 2015 to the advanced diploma level that would apply to all new advisors and any advisor who was choosing to expand the scope of advice that they were providing. And then from the 1st of January 2019, ASIC were proposing that there would be a degree requirement for existing advisors, for new advisors and those expanding the scope of the advice they provide. Then if we move forward to 2014, in June of that year, the Senate report into the performance of ASIC was released, and that made a number of recommendations, including the requirement for a degree for financial advisors, the introduction of of a professional year, a registration exam, regulated CPD, and also advisors mandated to be members of professional associations. We also had that same year the PJC inquiry into lifting standards in financial services, and that included a very broad package of recommendations, including the degree requirement, the professional year, the registration exam, CPD, and another form of code and code monitoring. With that same month, in December of 2014, the Financial System Inquiry final report was released, which also recommended that advisors be required to be of a degree level. And then it was in October of 2015 that the government finally came out and announced their intention to move ahead with the package that we have in front of us today. So not only did we have extensive demand from the Parliament, we also had pressure from consumer groups, and we had a very strong focus on it from media outlets. So back at that time, there was a number of articles run in the mainstream media, including one front page article in The Australian that referred to how simple it was to become a financial advisor with just 4 days study. And that's a statement that's been repeated many times since. So the momentum for change at that point was very, very strong. Now, in the lead up to that announcement by the government and in the first stages of the initial consultation afterwards, the AFA had a clear policy position. What we thought was the right outcome was that existing advisors would be required to upgrade to an advanced diploma, which is the AQF level 6. And I'll talk about that a little bit more shortly. But most importantly, in order to avoid the confusion and anxiety that we've got now, we said that the government should set that standard and not leave it to a standards body. And we made this recommendation in our response to the FSI report and also the PJC report on lifting standards, and also in response to when the government released the draft legislation back in January of 2016. Of course, things have progressed since then, and the government has made it clear that what they expected as an outcome here was degree equivalence. Now, if I just take you through this diagram, what it's showing is the different levels. So what we're familiar with is the Diploma of Financial Planning at AQF Level 5, which is a 4-subject course, the Advanced Diploma at AQF 6 being another 4 subjects, and obviously for those who did their diploma a number of years ago when it was 1 to 8, that covered basically both of those 2 courses. But that red line there is intentional because what the government has said to us is they require the education standard for existing advisors to become degree equivalent. Now, if you go above the red line, the first line there is the undergraduate degree at the AQF 7 level. However, that involves 24 subjects. Then there's the graduate certificate at AQF 8 for 4 subjects, the graduate diploma also at AQF 8 at 8 subjects, and finally a master's degree at AQF 9, 12 subjects. So in terms of what the government expected, they wanted it above the line, but obviously we didn't want advisors to need to do a full 24 subject course. So it really came down to whether it was going to be a graduate certificate or a graduate diploma. And as we know, the government and FACEA in the end have chosen the right outcome is the graduate diploma. So let's put a little bit more context around the overall package of reforms that is part of this. It was actually made law in February of 2017, so the law has existed for over 12 months. The first key date is the 1st of January 2019, which is when the degree requirement for new advisors kicks in, as does the professional year and the exam for new advisors. CPD requirements for all advisors will be stipulated by a FACEA standard. The next key date is the 1st of January 2020, which is when the new FACEA Code of Ethics will come into play. There'll also be compliance schemes and code monitoring bodies, which is a new layer of oversight that we haven't seen before. From the 1st of January 2021, all existing advisors will need to have passed the registration exam. And then the final key date, and the one that I think has generated the most concern, is the requirement for all existing advisors to achieve the degree equivalency standard. So since FASEA has come into force, we've seen two really important announcements. The first one was in October of 2017, and this was really a focus upon what they expected of new advisors past the 1st of January 2019. They, in that announcement, utilised the Financial Planning Education Council's curriculum and list of approved undergraduate and postgraduate degrees. The Financial Planning Education Council is a body that was set up by the FPA back in 2010, and it goes through the process of reviewing degrees that are available in the Australian marketplace. Now, that first announcement didn't generate such a big response. It was the second announcement just prior to Christmas, which was focused on the requirements for existing advisors and the introduction of the idea that existing advisors without tertiary education would need to do a graduate diploma. That is the release that has generated a lot of heat over the course of the first few months of 2018. Now, if we have a look at exactly what that standard is proposed, what they've said is that for those without a degree, they would need to do an 8-subject graduate diploma. Now, there's a range of different categories, and we'll go into this in just a moment, but they've also talked about advisors who have a financial planning degree that isn't currently approved, and they've suggested that those institutions could retrospectively apply for it. Now, one of the groups that is most concerned about the announcement has been those who already have degrees, and that's really split into two key groups: those who have a relevant degree, and we'll go through that shortly, and those who have an unrelated degree. But what they said was that each of these groups would need to do a bridging course. Now, there was no details released on what those bridging courses may require, and whilst FASEA recognised that they would be accepting prior learning, they provided no further details on that either. Importantly, what has happened since that announcement is there's been a lot of misunderstanding, a lot of concern and confusion. One of the things that has been covered in blog stories repeatedly is that FASEA were in some way suggesting that degrees that were older than 10 years would not be recognised. We've since had that confirmed that that is not the case. So FASEA will recognise degrees that are older than 10 years, and in fact, they will not be putting an end date on any degrees. They also framed this in a way where they talked about the options that are available for people. So people with degrees were advised that they could choose to do one of the approved courses, or a graduate diploma, or wait to see the bridging course. Now, FASEA also made no reference to professional designations, which has been an issue that has caused a great deal of concern. Many people have invested significantly in their professional designation and were expecting that it would be recognised in some way. This is still an issue that needs to play out, and we will continue to argue that there needs to be recognition for professional designations. Now, for those who have actually read FASEA's announcement, right at the back is a flowchart. The flowchart is certainly confusing. It was a long, complex document and has certainly led us to appreciate the need to provide further guidance. Okay, let's go through this in each category. Now, it's important that we understand how it's going to impact each group. So the way it was drafted was that they spoke in detail to a range of different groups. So what we've done here is we've split it into 5 key groups. The first group is those who have an FPEC approved degree. Now, FASEA have said in their December announcement, this group is already approved and will not need to take any further action. There are also a range of people who have completed financial planning degrees but degrees that may not have been on the FPEC approved list. So what FASEA have said is that this group could, through their education institution, apply to have retrospective recognition. Now, for those advisors in this group, we would strongly recommend that you go back to your education institution and ask them very firmly to seek that recognition. The third group is people who have a relevant degree. Now, a relevant degree is accounting, business, commerce, finance, economics, and law. Now, this particular group are those that were probably most concerned by the announcement, thinking that they had already invested significantly in their career. They've no doubt also presumably done the DFP, the ADFP, and maybe a professional designation. What FASEA said with this group is that they will be making available a bridging course. And we would obviously recommend for this group that you wait to see what that bridging course looks like. But our very strong understanding is that that will be substantially less than completing a full 8-subject graduate diploma. The fourth group is those who have an unrelated degree: art, science, teaching, engineering, etc. Now, FASEA has proposed that this group could do a bridging course. Once again, we're not sure of the details of that bridging course, and we would certainly recommend that people wait to see the detail of it. The final group, and this is undoubtedly the largest group, is those who do not have any tertiary qualification. This is the group that FASEA have quite clearly said they will expect you to do a graduate diploma. What we say for this group is that the biggest and most important issue here is going to be looking at how much credit you will get for your experience and your previous study, and we'll certainly be advocating to maximise that credit. Let's go back and reflect upon some of the core positions that the AFA takes in this. It's no doubt that FASEA are very focused on raising education standards to meet consumer expectations and obviously the expectations of the government. They're also going to be very focused on raising the minimum level of ethical standards. What we think the whole debate has unfortunately lost is the balance that needs to be placed on the solutions to ensure that we maximise the number of existing advisors that stay in financial advice. So we believe that if there's more balance in this debate, we will get a more sensible and pragmatic outcome. Some of the other things that we think are really important as part of this overall debate and the process of consultation we have in front of us is that advisors undertaking further education should be able to do it in an area that is of value to their business and is of interest to them personally. We also think it's really important that in the solutions that are brought forward for advisors, that there are solutions that are tailored to their specialist areas. We've had a lot of feedback from risk specialists that they only want to be doing study in areas that's relevant to them. And that's something that we firmly support. Another group of advisors who have expressed strong concerns is those who are more mature and probably closer to retirement. And they're questioning why they should do so much study if they're only going to be in the industry for another 5 to 10 years. And we absolutely recognise where this group is coming from, and this will be some of the advocacy work that we do. At the end of this, it's been quite unfortunate that it's become such a hot, heated debate, because really what's important is we need to ensure that we get the engagement and commitment of the advisor community, we win their hearts and minds to stay part of this process, to achieve recognition and to be able to continue to operate in the financial advice sector. I'll just make a few extra points about FASEA. It's important to note that the CEO is Dean Sanders. He's only been in that role since September of last year. FASEA has a huge amount of work to do. Not only are they focused on the degree requirements, they also need to build the code of ethics, the registration exam, the professional year, and the ongoing obligations for CPD. Now, we know that advisors are not only concerned about the registration requirements for education, but they're also concerned about the registration exam. Now, what we expect this exam to be is a single standardised exam across all advisors, a multi-choice exam to have some but very limited technical content. And what it does contain will need to be stuff that is common and relevant to all advisors. It's likely to cover your legal obligations and the FACEA Code of Ethics once it's released. Now, consultation on all of this is going to take place over the next few months, and we strongly encourage all advisors to be active in this process, including for those who wish to make submissions. Now, it's very much appreciated that this has been a challenging time for financial advice, and there's been many advisors who have contacted the AFA to express their concerns. We very much appreciate that this is a very challenging time, but we would also make the point that those who have operated in this sector for a long period of time, have lots of experience, have lots of value to add. Don't underestimate your capacity to get through this. You've proven that over many years in responding to the different things that have happened in the industry, and you're still here. So we believe that you have the capacity to continue and overcome this challenge. Avoid making rash decisions. There's already a number of people who said, well, I'm not going to stick it out. We would ask that you don't make those decisions quickly and wait till the final outcome is available. When you do work out what education you want to do, we recommend that you do it with a group of friends. The old peer group concept is something that's been so important to financial advice, and make sure that, that people can do what they need to do with people who are there to support them and help them get through it. Now, it's quite likely that the additional study that people commence doing will also help them to pass the exam. That's an important consideration. So at the end of the day, we appreciate that this is going to be a very challenging time. However, we believe that we can get there, and it's just a matter of one step at a time and staying engaged and part of the debate. So next steps for the AFA, FACEA consultation will commence very, very shortly. We're expecting further details quite soon, and we will strongly argue for a more sensible and pragmatic outcome. Financial advisors should also actively engage in this process and put their views forward to FACEA. And you might want to put your views forward on a range of different things, whether it's what the standard should be or it's how your specialisation is addressed as part of this. We have already been actively talking to politicians about this issue and the impact that it's had on advisors and why we're seeking a pragmatic outcome. And we'll continue to work through this. The other key thing that we can do is to work with the education institutions to make sure that the solutions that are available for advisors meet their needs and align with their interests.
Thanks, Phil. Folks, as Phil said, we know it's a very emotional issue, and you know, we have a lot of work to do in terms of advocating on your behalf. We do believe that the assessment will not cover areas that you're not a specialist in, and we will continue to advocate for the fact that specialists need to be recognised. That is the strongest feedback that we've received regularly. It's around the speciality, the time it takes for the education, and of course the financial investment, and where you are relative to your stage in your career. We know how important that is. We have been taking some polling questions around the countryside, and we're going to give you the opportunity to participate in that poll. So we're going to ask you two questions here. And the first poll question is, what is your thinking in terms of new education requirements? And the options there, so you will have the option of clicking on poll on your webinar invitation. So there will be the poll questions there. And so the first question is, what is your current thinking in terms of the future education requirements? Option A is, I'm excited to do further study. Option B is, I'm not looking forward to it. However, I recognise the importance of doing more education. C, I'm uncertain as to what I intend to do. Or D, I have real reservations about this and intend to leave the industry before 2024. We'll give you some opportunity to answer those questions. There is a second question I'm going to ask you. In terms of the new professional standards obligations, what are you most concerned about? Passing the registration exam? Is it achieving the new education standard? Or is it the new code of ethics? Or I have no concerns about any of this. We welcome your feedback. Give you a couple more seconds to get your responses. So the last question, in terms of the new professional standards obligations, what are you most concerned about? Passing the registration exam, achieving the new education standard, the new code of ethics, or I have no concerns about any of this? So you can see there's a fairly consistent result. And we've seen this when we've travelled around the countryside as well. 44% have said, of question one, what is your current thinking in terms of the new education requirements? 44% have said, I'm not looking forward to it. However, I understand the importance of doing more education. And that's extremely positive. We recognise there will be some challenges, but obviously a lot of you are up for that challenge. There is a large percentage, obviously, who've said I've real reservations about this and intend to leave the industry before 2024. And as Phil said, one thing we've just asked to do is don't make any rash decisions until the dust is settled and we understand what everyone is required to do. In question two, in terms of the new professional standards obligations, what are you most concerned about? Overwhelmingly, achieving the new education standard is the biggest challenge. And that is, again, consistent in some of the polling we've received around the countryside. And that's where, as Phil said, we'll be working with FACEA in terms of our consultations and with education providers to make sure that we can ensure that the future education available and the courses available and the content of those courses is relevant, as well as achieving the levels that are stipulated by the government and FACEA. So thank you for that. We'll have some opportunity for questions for Phil a little bit later. Now, in terms of policy and professionalism, Phil, I'll hand it back to you.
Before we leave the issue of education, and we do have a few questions which we'll come back to at the end of the session, I'd just like to remind participants of the AFA's campus team, Mina and Mark, who are available to answer any questions about your education requirements and assist you in understanding what your options are going forward. Okay, moving on to the next subject of the Royal Commission. I guess many people have probably been reading the paper over the course of the last week. Hearings into lending products started last Tuesday, and it certainly generated a lot of media coverage so far. The government tried very hard to resist the Royal Commission for quite some period of time. It was first actually recommended back in June of 2014. However, by the end of last year, when the big banks called for the Royal Commission to happen, the government decided that it was unavoidable. The problem was that they'd already made a number of commitments in advance of this, things like the introduction of AFCA and the introduction of the Banking Executive Accountability Regime, which were measures designed to appease those calling for a Royal Commission. So unfortunately, we got the best of both worlds with those new measures put in place and also the Royal Commission to kick in. Now, I'll just quickly go through the scope of the Royal Commission, and it's very important to understand what it's looking at. It's looking at misconduct. and whether that misconduct has been dealt with appropriately. It's also looking at conduct, practices, behaviour or business activities by financial services entities that fall below community standards and expectations. Now, the third point on this slide is where the government has included superannuation funds in the scope, and they're looking at how their money has been spent and whether it's been in the best interest of members. There are a range of other parts that they're looking at. They're looking at culture and governance practices with a focus on things like risk management, recruitment and remuneration. The effectiveness of consumer redress arrangements, so the external dispute resolution arrangements. The adequacy of the law and the policies of the government in order to facilitate those outcomes, the effectiveness and ability of regulators to identify and address misconduct. And then at the end, it's all about whether there is a need to make any changes to those frameworks or the arrangements with respect to regulators. Now, key to this is the inclusion of a financial services entity, and the definition that's been set out in the letters patent as part of the Royal Commission is that a financial services entity includes authorised deposit-taking institutions, which is banks, building societies or credit unions. It also includes general insurers, life insurers, and where our sector is impacted, AFSLs and authorised representatives. As we talked about before, it also includes superannuation funds and trustees, and as we saw as a key focus last week, intermediaries between borrowers and lenders. So we had a lot of coverage last week with respect to mortgage broking. Now, to this point, as at the beginning of last week, the Royal Commission had received approximately 1,900 submissions from the general public. Now, there have been two hearing sessions set up. The first one starting last week and continuing through to the end of this week is focusing on lending. And the second one, which is due to start on the 16th of April, is focusing on financial advice and wealth management. So we can very much expect that in that period of time, we will see a lot of coverage of things in financial advice. And obviously some of those public submissions have been focusing on financial advice and things that might have happened in the last 10 years. We're already aware that a number of institutions have been required to make submissions to the Royal Commission. That has recently been extended to include some of the non-institutionally owned licensees in the financial advice space. As we know, the Royal Commission is very much focusing on submissions from the public, and what they're going to be doing is cross-referencing the submissions that they receive from institutions, the regulator, FOS and others against the public submissions. Now, the first hearing was really an introduction by the Commissioner and the Senior Counsel assisting on the 12th of February, and that gave us some insight into how this is going to play out. Financial advice will become a core focus, and we can expect to see a lot of things being raised there. Obviously, for anyone at the licensee level, there's always a risk that they will get caught up in this. What our advice is you will only be given a very short amount of time to respond, so it's very important to prepare immediately, get advice, external advice, and respond promptly. Okay, I'd like to move now on to talking about AFCA, the Australian Financial Complaints Authority. The legislation for this has now been passed. It went through the House of Representatives, so it's been through both houses and was finalised on the 14th of February. Now, the Minister made a statement the day that it was finally passed and said that AFCA will come into play from the 1st of November this year. And FOS, the CIO and the SCT will be merged in, but they will continue to process the existing complaints that they have on hand. From the AFA's perspective, the biggest issue with AFCA is the key issue of increasing the monetary limit for compensation applications that they can receive and process, and that's being increased from 500,000 to $1 million. So that means where a client has lost up to $1 million, the complaint can be submitted to AFCA and be considered. Equally importantly is increasing the compensation cap, which is the amount that AFCA can award from 323,000, which is the new threshold that kicked in from the 1st of January this year, all the way to 500,000. So AFCA can make determinations of up to $500,000. And as we know, those decisions are binding on the financial services provider. And equally importantly is those decisions are not subject to appeal. So this is a very important consideration, and our concern is very directly with the implications that this might have for the cost and availability of professional indemnity insurance. Now, the government didn't do a regulatory impact statement with respect to this legislation, and the explanatory memorandum did not deal with the implications for PI insurance. We've made the point repeatedly to the government that they need to understand the implications for PI, and we've most recently reinforced this with the Minister. But we note that in her speech to Parliament as part of the final debate on this legislation, she made a number of comments that suggest that she doesn't feel that the existing caps went far enough. So she made comments like, they're manifestly too low. They weren't working in a way to give access to justice for consumers. The use of the word justice is interesting there because from our perspective, justice is justice to consumers, but it's also justice to the financial services provider that's impacted by those determinations. She went on to suggest that the current caps bear little relationship to the value of most financial products and are no longer fit for purpose. We don't agree with that, and we'll continue to advocate that these caps shouldn't be increased or there should be a delay in any increase. The other thing that's been on the agenda for some time as part of this complaints world is the idea of a compensation scheme of last resort, which would be a mechanism to compensate people who, for whatever reason, are not paid out with respect to the determination that they get from FOS, CIO, or the new AFCA. And that may be because the financial services provider has gone into liquidation and is no longer able to pay. So the talk is about a scheme that would address them. But the government has put this on hold until after the Royal Commission. I'd like to make a few quick points about the life insurance framework. As we will all appreciate, it has already commenced from the 1st of January this year. So the new cap is 80% plus GST for upfront commission and 20% plus GST for ongoing commission. A 2-year clawback period has also come into play. Now, applications that were submitted before the 31st of December, but for whatever reason have been held up through underwriting, need to be finalised before the end of this month in order to be processed on the old upfront terms. But also make the point that if you provided advice last year and the clients have come back more recently and said, we want to go ahead with it, it's important that you provide a record of advice to them to notify them of the change in commissions that will apply. Now, please check carefully with what insurers are actually paying in terms of upfront commission. Two key parts of this are inclusion of policy fees and frequency loading in the calculation. Not all insurers are paying it on both, and that is obviously an issue for us. Risk Info released a story late last week that included a table that set out who's paying what. We will continue to advocate strongly with life insurers to ensure that come next year when the upfront goes down to 70%, that as many of them as absolutely possible are paying it on both. And our other point of concern about this is the confusion that it will create. And obviously, next year, if we can get them all to pay it on both, then it will make the process of preparing SOAs and getting your disclosures so much easier. Now, the last thing that we're going to cover here is some other key policy developments. For those of you who have been following the Parliamentary Joint Committee report on life insurance, the final report on that is due out before the end of this month. That's one that we're going to be watching very closely. We expect it to raise a number of concerns about direct insurance and also with respect to the claims process. ASIC this year is running an inquiry into direct life insurance, and they've said that their report will come out by the end of June this year. Now I'm going to put a slide up very quickly that shows a little bit of context around ASIC report 562, which had a look at vertically integrated institutions and how they're managing conflicts of interest. The Productivity Commission has made 2 recommendations in their draft report that are relevant to financial advice. One is with respect to the removal of the term general advice. The other one is around allowing financial advisors through their AFA license to provide some advice around some basic lending products. The FSC late last year released their APL policy for life insurance, which required at least 3 life insurers and also a non-approved product process. Also quickly going to take you through the Insurance in Superannuation Voluntary Code of Practice. But before we do that, I'd like to emphasise that we are very conscious that the cost of providing financial advice has come under pressure in recent years from a number of changes, whether that's the ASIC levy, the cost of AFCA, the cost of running FASEA, and most importantly, education. So very quickly having a look at report 562, this I think covers the key messages of it. It was saying that whilst those licensees provide breadth of products on their APL, the majority of funds are flowing to in-house products. That really didn't come as a surprise to us. It was their feedback on the quality of advice that was more concerning, suggesting that 25% of advice was compliant, and then of the remaining 75%, 65% was non-compliant, but another 10% was non-compliant, where ASIC thought that there was significant concerns about disadvantage or loss to clients. Now, in terms of the Insurance in Superannuation Voluntary Code of Practice, this is quite important for advisors who do provide risk advice. We were most disappointed that this document played no recognition to financial advisors who are so important in assisting clients to get the right cover. One of the key principles that it has is that trustees need to ensure that that their members are only paying up to a cap of 1% of their salary in insurance premiums. This is being assessed across the whole membership base, but we think those caps may put people at risk of not getting the level of cover that they require. The other key part of it was where clients have ceased making contributions. What proposed is that where it's insurance for income protection, that would be cancelled after 13 months. Where it's death and TPD, what they've said is that after 13 months, it would be cancelled if the policy has a balance of less than 6,000. Now, clients will have the ability to opt out of this, but we're very conscious that there's a great risk that in many cases they won't. So this is a key issue for advisors who have clients in that situation. The start date is the 1st of July this year. However, it's voluntary and participants have until the 30th of June 2021 to comply. We think that some of these measures are over the top and they're going to lead to disadvantage for consumers in terms of the adequacy of their insurance cover and whether it's at risk of being cancelled when they want to keep it. The Minister and the media, unfortunately, seem to think that it doesn't go far enough. So it's going to be interesting to see how this plays out. Right, I'd like to now turn back to Phil Kewen to finalise.
Thanks, Phil. I'll just go through a few things just while Phil has a chance to look at any questions that you may have sent through. I talked about at the outset the importance of financial advice and financial advisors in the community. I just want to touch on two areas where you can be involved in the AFA community. The first one is the Pro Bono Financial Advice Network. This is where you give pro bono advice to families who are in need. Usually in times of distress, they've lost a loved one, there might be someone who's sick. In this instance, we've been piloting with MS Australia, and we're in discussions on a national rollout with National Disability Services. If you are interested in participating, this may just be sitting down, helping someone understand their financial circumstances, not necessarily giving full advice. If you are interested, there's some contact details there. Secondly, the AFA Kokoda Track, very successful last year. We raised over $40,000 for various charities. The AFA Foundation has in fact raised over $1.4 million over the last 10 years, thanks to your support. It's led by Norgay Freeman. There are still 10 spots to be involved. I haven't started my training yet, but I am definitely going to do Kokoda this year in August, September this year. So there are details on the website, or feel free to give me a call if you're interested. So there are two areas that we're really participating actively in the community. I guess another one I wanted to touch on as well, and this is really important because, as we said at the outset, the future of advice has never been greater. The need for advice has never been greater, but we understand we've been through a lot of change, and there are a lot of challenges that you face, both from a career perspective and from a day-to-day perspective. Everything might be fine, but if it's not, AFA Care is there for you, your staff, your families. It's a counselling hotline you can ring up. It's confidential. Just get some information, some tools. Just have someone to talk to. There is a website that's just been refreshed due to the brand change of our provider, but that's something to make yourself available to. So if you're just feeling you just need that conversation before maybe a tough conversation with a client, or after a tough conversation with a client or a staff member, AFA Care is available for you. So just looking at the road ahead, shortly we'll be sending out a member survey. We want to get an understanding of where our membership is in terms of their education status. So we'll be sending out a survey. I would encourage you, everyone, please participate. Please go into your filing cabinets, your hard disk drives, your pool rooms, find out all your existing qualifications so we know exactly where you're at. As Phil mentioned, we're in a FACEA consultation process. We'll be consulting with FACEA, not only us as the AFA, but we understand there'll be consultation with advisors and licensees, and likewise we will be doing the same. Phil and I are heading to Canberra next week, and we'll be once again advocating the value of advice. And we'll be seeing MPs on both sides of Parliament because we just don't know what the future holds. And it's really important as we go through all this legislative change. If there is a change in government, then we ensure that there's not a huge set of changes all over again. One thing that is really important, now, I would emphasise, if you've already done your homework and you know that what your education pathway is, it might be a Masters in Financial Planning, it might be a graduate diploma. If you're ready to do that, then by all means, go right ahead. Time is of the essence, and it doesn't hurt to start right now. However, we will be continuing to engage with universities and education providers to ensure that we provide you with the tools to find out what the course is applicable to you when some of the rules are more clearly identified, and help you in that transition through the education phase. We'll continue to advocate and influence to ensure that advice and advice practices into the future going to be robust and have a great future. It is so important, which is why we spent time with the Minister for Small Business a couple of weeks ago. This is so vital. We have such a rich foundation for the economy, both in terms of our business and in terms of the expertise. As mentioned, through this backdrop, we're going to continue to promote the positive outcomes of advice to the community and to the government. And of course, as you've indicated, we want to keep you informed. For example, the Connect presentations, our recent roadshow, all of those presentations from the award winners and including Phil, are on the website, and a video of this will also be available shortly. So on that, just to finish off, Phil, if there is any questions.
Yeah, so we do have a number of questions. The first one is, are there CPD points for attending this webinar? And we can confirm that is the case. Another question, where do I find the FPEC approved degrees? And this is an important point because anyone who's got a financial planning degree should be looking to see whether it's covered or not. Now, that list is on the FASEA website, which is fasea.gov.au, and you can have a look under the announcements that they've made, and they are available there. Are the slides going to be made available, which we can confirm is the case? So the slides from today will be available to participants. What purpose does the FCHFP serve at the moment from an education point of view? Well, that's a good question, and we will continue to advocate strongly to ensure that the FCHFP is recognised in some way in this process, whether that be in credits towards the graduate diploma or in some other form. So we'll continue to advocate strongly for that. The FCHFP, though, as a course, still has value in that it does educate those who do it in a range of other areas that add value to their business. So that's an interesting question, and one that we will come back to. Next question is about the slides, which is good. Is there a ruling on education standards for general advice businesses? And this standard only applies to people providing personal advice to retail clients. So there is no impact on people providing general advice as a result of this proposal. Question about if the minister isn't supportive, then are we talking to other members of Parliament? And as Phil has already said, that's something that we will always actively do, is engage with a range of different members of Parliament from both sides of the House. So question here, hi guys, where do you see the FCHFP fitting into the education requirements, assuming business degree and advanced diploma has been achieved? So we will continue to advocate for the FCHFP, and we recognise that that might sit alongside other education that people have already done, and they need to be appropriately recognised. There's a question about representation on the FASEA board and whether there's enough financial advisors on that board. Now, at the moment, there's one advisor and there's one licensee head. And whilst we might have concerns about whether that board has an adequate understanding of the issues facing financial advisors, the actual composition of the board is set, and it's a decision of the minister, so it's not going to change. A question about what's our gut feel in terms of how this might evolve. Well, I think the advice community has already done a lot to publicly express their concerns. We've seen that feedback get through into the political process. So we would expect to see some changes, but we've got work in front of us to ensure that that happens. There's also some chat points made, and there's making sure that things are adequately recognised and people have choice, which we agree with. A comment about being able to enrol in the graduate diploma without having previously undertaken an undergraduate degree. That is potentially an issue, but people without an undergraduate degree can start doing the graduate certificate that then does roll into the graduate diploma. We don't expect this to be an issue, and we would expect that the institutions will get that organised. Question about, we can't make any decisions until they clarify the requirements. The concern is that there won't be enough time allocated to meet requirements once they decide what it is. Well, we would hope that we will get greater clarity very soon, and also that things will be resolved before the end of this year, so that there is still 5 years to get everything done. We recognise that the sooner people have clarity, the better. We also recognise that this study is going to consume people's time. That's going to distract them away from their business and away from their family. So we appreciate the importance of that. So another question about the SCHFP. When the bridging courses will be released, we expect that we'll get guidance on this very shortly. This was fantastic and easy to understand the new code. Thanks, that's more a comment, which we appreciate. Can you please send through this risk info link, which outlines which insurers are passing on comms for frequency loading and policy fees, which we will do. We are out of time, and whilst I've been answering the questions, we've had a bunch more. Will the government pay my wage while I study? Good question, a little optimistic one might feel, though. We appreciate the impact that it's having, but that's unlikely to happen. A comment about adding to fixed costs, and that's certainly the case. What would your advice be for someone who is just about to finish their diploma in financial planning and going to be authorised as an advisor mid this year surrounding the education standards? A good question, and one that's important for people who are principals and employing people in their business, that people need to be authorised by the end of this year in order to be treated as an existing advisor. If you're not, you become a new advisor, and all the new standards start from the 1st of January this next year. For those authorised by the end of this year, they will be treated as an existing advisor, and they will have until 2023 to resolve their education requirements. We are out of time. I appreciate there are more questions that have come through, but we do need to wrap it up.
Thanks again so much. Thanks, Phil. Thanks for your attendance today. Really appreciate it. As always, if you have questions for myself or for Phil, please feel free to come directly. Have a great day.